Welcome to the deep dive. Today we're analyzing a really fundamental and profitable shift in how the world is looking at critical resources. We're moving way beyond just betting on a single commodity, lithium's up, gold's down, that kind of thing. We're looking at a whole new paradigm for investing based on the complete restructuring of global supply chains. Our mission today is really to crack open the thinking behind this new approach. And the results we're unpacking are frankly extraordinary. We've got a selection of companies here delivering truly market-beating returns. We're talking doubling investor value, sometimes more, pretty quickly. And the key finding, the thing we really need to dig into, is that these wins weren't just luck or even just riding a lithium wave. They won because they set themselves up with what the analysts are calling multiple irons and growing fires.
That phrase, yeah, multiple irons and growing fires, that really captures why this is a deep dive and not just, a simple market update. What we're seeing unfolding right now is probably the biggest reshaping of commodity markets since Bretton Woods after the war. It's structural. This isn't just a cycle. And for you, the listener, you need to grasp the three huge structural shifts forcing this new paradigm. First, there's the energy transition. I mean, it's massive, baked-in demand for battery metals. Unprecedented, really. Second, geopolitical fragmentation. Resource nationalism, everyone's scrambling for supply chain security. And third, something maybe subtler but profound, monetary system evolution. Central banks are quietly but definitely diversifying away from currencies they see as, potentially weaponized.
And this isn't just theory, is it? The sources are pointing to really specific examples of governments getting directly involved.
Exactly. I mean, look at the news around Lithium Americas. The reports say the U.S. government is looking for potentially a 10% equity stake. That's part of renegotiating a massive, $2.26 billion Department of Energy loan for their Thacker Pass project.
Yeah.
This isn't just support anymore. It's active industrial policy. High stakes. And we're seeing similar things, strategic stakes, maybe in MP materials for rare earths, maybe even Intel. Governments are now directing, financing, securing these supply chains.
Okay, wow. That context is seismic. So if governments are basically redrawing the map, how does an investor, translate those huge shifts into actual profitable decisions? What's the framework, a strategy that actually generated those incredible returns we mentioned?
Well, it boils down to probability, really. Why bet everything on one commodity, one outcome, maybe a 25% chance? Instead, you structure things so you benefit from, say, 4 different macro scenarios that actually reinforce each other. The framework lays out 4 essential irons you need to have in the fire.
All right, let's break those down. Where do we start? The foundation.
The first iron, let's call it the lithium foundation. Every single one of these high-performing companies had significant lithium exposure. That gives you the basic leverage to the energy transition trend, which, despite price swings, is structurally intact globally. I saw analysis from 10Cap's Junbei Liu noting lithium markets have actually been quietly improving, partly due to Chinese mine shutdowns easing that oversupply. So lithium is kind of the price of admission here.
Okay, understood. Lithium's the base layer. But you're saying the real edge, the alpha, comes from understanding government moves.
Yeah.
That sounds like the second iron.
It absolutely is. The second iron is U.S. strategic minerals. And this isn't just hoping, it's about sophisticated alignment with actual policy. We are talking about government intervention in commodity markets on a scale we just haven't seen in peacetime ever. Think about the money flowing. $52 billion from the CHPS Act for semiconductors, constant use of the Defense Production Act for critical materials, and already over $3 billion in DOE loans specifically for domestic lithium projects. It's like state-sponsored de-risking of these ventures.
Unprecedented peacetime government intervention. That phrase really hits home. It implies just being located in the U.S. or maybe Canada or Australia is now a measurable asset, separate from the commodity price itself.
Precisely. And that flows right into the third iron. The conflict in Ukraine was a stark lesson, wasn't it? Resources, oil, gas, even fertilizer, they can become weapons overnight. So the third iron is geopolitical commodity positioning. Supply chains are being rebuilt, consciously, around security and reliability, sometimes even sacrificing pure cost efficiency for it. And that means projects in allied countries, US, Canada, Australia, they now get premium valuations, they get preferential treatment from policymakers, they offer stability. And in this environment, stability is gold.
Security over cost driving value. Got it. And the fourth iron, the bigger picture.
The final piece is monetary system evolution. Central banks worldwide are getting nervous about relying only on reserve currencies like the dollar that could be, weaponized through sanctions or just devalued. So they're diversifying into physical assets,
Right.
especially gold. We saw a record central bank gold buying in 2023, and the pace is picking up in 2024. So companies with some gold exposure, even just as an option, have this built-in structural hedge against global currency jitters.
Okay, now here's maybe a slight pushback. If you're holding four different strategic irons, lithium, U.S. policy alignment, safe jurisdiction, gold, isn't that just, well, over-diversification? Does the complexity, the cost maybe, of managing all that dilute the potential upside if one thing really takes off? Are you just diversifying away your alpha?
That's a really fair question, but I think it slightly misses the core insight from the sources here. You're not betting on four different market cycles hitting at the right time. You're betting on four different scenarios, largely driven by structural policy shifts. The aim is resilience. So let's say lithium prices dip for a bit, but geopolitical tensions flare up. Suddenly, your gallium or niobium exposure, the stuff backed by defense policy, it picks up the slack. It creates multiple sort of independent routes to doing well. It's about robust strategy, not just focused speculation.
Ah, okay. Multiple independent pathways. That reframes it. Right, let's look at how this played out with the actual winners. We looked at 6 companies fitting this model. Maybe to keep it clear for you listening, let's focus on 3 distinct examples that really highlight this diversification approach.
Good idea. Let's start with the top performer, the one that more than doubled investors' money. That was Bayon Mining, BMM, a North American critical minerals play. Their strategy was clever. Yes, they had the foundational lithium exploration in Canada and the US check, but the real game changer for them was a gallium discovery.
Gallium. Okay, why is gallium so important right now for security for returns?
Because China controls something like 80% of the world's gallium supply. And gallium is absolutely essential for things like high-performance semiconductors, advanced solar cells, military communication systems, critical stuff. And Bayon's discovery happened almost exactly when China slapped export restrictions on gallium aimed squarely at the U.S. So overnight, Bayon's North American gallium wasn't just interesting geology, it became a major strategic priority. It plugged them directly into that government funding, that policy push we talked about. That alignment gave them a huge valuation boost.
Wow, perfect timing, perfect policy alignment, huge jump. Okay, what about a company that maybe started somewhere else entirely, not lithium first?
Right, that brings us to St. George Mining, SGQ. They're focused on Brazil, and they kind of flipped the script. They made rare earths and niobium their main focus. Lithium was secondary, sort of optionality. Now, niobium is fascinating. It's critical for the high-strength steel needed in major infrastructure, aerospace, defense. And the sources highlight that both the EU and the US classify niobium as having, I think, the second highest supply risk globally. Because production is so concentrated, St. George's project is right next door to the world's biggest niobium supplier, which helps validate their resource. And crucially, they've already signed an agreement, an OU, with a U.S. company, RE Alloys, that makes magnets for defense and aerospace. That cements their place in that security-first supply chain. That's iron number 3 right there.
Okay, so we've hit the semiconductor angle with gallium, the high-strength steel and defense angle with niobium. What about energy security, but maybe beyond just batteries?
Yeah, good point. That's where Infinity Resources I-88 fits in. They took a uranium-first approach. Lithium was the optionality for them. Their main projects are up in Newfoundland, Canada, and they've reported some really exceptional grades up to 7.5% uranium oxide, which is very high. So their positioning lines up perfectly with this whole nuclear renaissance trend we're seeing, the push for baseload energy security. They're essentially capturing both sides of the energy transition coin, the fast-growing battery storage demand with their lithium option, and the critical need for stable, reliable baseload power with uranium.
It really highlights how this diversification isn't just random. It's not just putting a few different eggs in one basket. It's calculated exposure to specific policy drivers.
Exactly. Calculated is the right word. And just to round out the picture, think about the other examples. We mentioned Zenith Minerals, ZNC, briefly. They actually pivoted to focus primarily on gold when that central bank buying trend really became clear, hitting iron number 4 hard, but they cleverly held on to their lithium rights. Strategic flexibility. And then you have Red Mountain Mining, RMX, maybe the ultimate diversification example here. They combine lithium in Nevada, gold in Australia, but then recently made a very timely acquisition, antimony in Utah. Antimony prices are near all-time highs right now, almost entirely because it's needed for defense stuff. And again, Chinese export restrictions are tightening. So RMX has exposure across the board: lithium, iron 1, gold, iron 4, safe jurisdictions, iron 3. and specific strategic minerals like antimony getting policy tailwinds, iron too. They've ticked all the boxes.
So if we tie this all back to that bigger picture context we started with, it really hammers home that these strategic commodity investments aren't just speculative bets. They seem like a measured, logical response to these huge structural, economic, and political shifts happening globally.
That's exactly right. And it underlines the sheer scale of this resource and nationalism trend. Let's just think about those numbers again. $52 billion from CATS. Over $3 billion in DOE loans just for lithium. Systematic use of the Defense Production Act. This level of government action fundamentally changes the risk-reward equation for resource companies. And this is where the jurisdictional advantage becomes so powerful. Western governments are actively, systematically favoring projects in allied countries. The US, Canada, Australia. This isn't just talk. It adds real value over time. These projects are almost guaranteed. Policy support, better financing terms, operational stability, things projects in more contested regions just can't rely on anymore.
Okay, so what's the key takeaway for you, our listener? What does this all mean? It sounds like the future of investing successfully in commodities is less about predicting one single price move and more about framing it through multiple possible scenarios driven by these big structural changes.
Absolutely. This framework essentially gives you 4 ways to win simultaneously. Scenario 1, lithium recovers. If lithium prices bounce back strongly, well, all these companies benefit because they have that foundational exposure. Scenario 2. Critical minerals acceleration. If specific policy initiatives really kick in for, say, gallium or niobium or antimony, then that exposure provides the real alpha, the outperformance. Scenario 3. Geopolitical supply chain security. Even if commodity prices are flat, assets located in safe, allied jurisdictions will likely command a premium valuation purely for their security and reliability. And Scenario 4. Monetary system evolution. If currency concerns continue or worsen, that central bank diversification into gold means any gold exposure really pays off.
It really feels like a convergence, doesn't it? The energy transition, geopolitics, the monetary system, they're all pushing in the same direction. This isn't just another commodity cycle. It feels like a structural necessity playing out. And the companies winning seem to be the ones who've moved beyond relying on just one thing. They've built resilience through this kind of diversified strategic positioning.
Which leads to a really important question, something for you to think about long after this deep dive. Given this unprecedented level of government intervention, this global shift towards structural resource nationalism, is that traditional clean separation between macroeconomic policy and commodity market returns just gone now? Are they permanently fused together?
That's a big thought to chew on. And building on that, if political security is now genuinely being prioritized over pure cost efficiency in how we source critical resources, which other everyday materials, things we currently source globally just because it's cheap, maybe basic aluminum, maybe certain types of steel, which of those might suddenly become strategic essentials overnight, demanding a whole new approach? Something to think about. Dive deeper. Thanks for tuning in.